Hey everybody, welcome back for another dividend investing video. What a crazy month October has been in the markets, with the S&P 500 up almost 7% for that month. But still, the markets are down over 18% for the last year, and there's still plenty of opportunities to long-term dividend growth investors. For today's video, I'm going to highlight 4 companies in particular that I believe are at a buying opportunity for the month of November, and in fact, I will be buying these and others just like them myself. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor, just a guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor and smash that like button and subscribe to keep up with our future videos. It really helps with the future growth of this channel, more than you can imagine. Let's get into it. 4 dividend stocks for November 2022, and stick around till the end. I'll cover a few additional companies I think deserve an honorable mention and a spot on your dividend watch list. Company number 1, Broadcom, ticker AVGO. Broadcom is an American designer, developer, manufacturer, and global supplier of semiconductor and infrastructure software products. Their products serve the data center, networking, software, broadband, wireless, and industrial markets. Headquartered in San Jose, California, Broadcom trades on the NASDAQ and is a component of both the NASDAQ 100 and S&P 500. They began as a division of HP Associates in 1961 as the semiconductor division of Hewlett-Packard. The company we have today is a result of numerous spin-offs and acquisitions since that time. Year to date, Broadcom is down nearly 30% and is trading in the 460s at the time of publishing. Don't be deterred by the high share price. You can do like I do and buy fractional shares. This sort of thing should never prevent you from investing in a company that fits your criteria. Broadcom is one of my favorites in the semiconductor space, and there's so much to like here. This is one of those compounders. Over the last 10 years, shares are up over 1,200%. They also pay a dividend that is growing at one of the strongest rates in the market. All that price appreciation you'd expect an overvalued stock, but that is not the case at all. Broadcom is trading at 11.5 PE, and that is lower than its 5-year average of 13.8. Compare this to the information technology sector of 19.1. So Broadcom's dividend is at a 3.52% yield, and this is 6% above its 5-year average, suggesting we are slightly undervalued by that metric. The dividend is paid out in quarterly payments of $4.10 per share every March, June, September, and December, for a total annual payout of $16.40 per share. Broadcom has a forward earnings payout ratio of 41% and a free cash flow payout ratio of 45%, which makes this dividend look plenty safe. Simply Safe Dividends provides a safety score of 67. And check out this extremely aggressive growth track record. 11 years of dividend growth, averaging at 43% over the last 5 years. Now this is slowing down, as the latest was 14% back in December of 21. A very impressive rate of growth, however. We should be hearing of the next increase for the upcoming December 2022 payment shortly, and we shareholders are eagerly waiting word on that. I'll make sure you are kept in the loop, so be sure to click on that notification bell and subscribe so you get those future updates. Now, we can see why they've been able to grow at such an impressive rate. Check out this revenue growth. It was $2.36 billion in 2012. In the last 12 months, it's been $31.7 billion. The one downfall I can see is the issuing of shares. They are up huge over the last 10 years, and shareholders have become diluted. Granted, the gains for the stock resemble a growth stock, and they more than make up for it. And companies will do this when everyone is buying up their stock. But it's something to keep an eye on, and I would like to see them reverse this trend and maybe start buying back some of these shares now that they are cheap or cheaper. Wall Street is bullish on the stock. 26 analysts have rated Broadcom in the last 90 days. 17 rate it as a strong buy and 5 rate it as a buy. 4 rated the stock as a hold, and no one rates it as a sell. The average analyst price target is $649.33, which represents nearly 40% upside from current prices. With Broadcom, you get it all. You get price growth, dividend income, and dividend growth. I love this one, and I've been buying it up in our dividend growth income portfolio. Company number 2, Union Pacific, ticker UNP. Owning Union Pacific is owning the railroads and investing in the American supply chain. Formed in 1862 and headquartered in Omaha, the rail network includes over 32,000 miles, connecting the Pacific Coast to places in the American Midwest and the Gulf Coast. They are the largest railroad by market cap at $126 billion. Union Pacific is one of my favorite stocks in the industrial sector, with an impressive history as a compounder with excellent dividend growth stats. Even now in 2022, railroads remain one of the most cost-effective means to transport goods and materials, and this company has a moat that very few others can claim. Union Pacific is trading just below $200 at the time of publishing and is down 20% in the last year. Zooming out, shareholders who simply buy and hold this one have done quite well, sitting on a 227% gain just in price. That doesn't count dividend income. Union Pacific is trading at a PE of 16.9, which is a few points below its 5-year average of 19, suggesting this could be an ideal time to scoop up some shares. Also note that it's a bit below the sector average of 17.9 for the industrial sector. Another one of the tells I like for a stock ready to buy is its dividend yield is high above its 5-year average, and Union Pacific's dividend of 2.64% is 27% higher than its 5-year average. Union Pacific follows the quarterly dividend payout schedule of March, June, September, and December, and the current quarterly payment is $1.30 for an annual payout of $5.20 per share. Union Pacific maintains a healthy dividend payout ratio of 45% of forward earnings and 53% of free cash flow. It checks those boxes. Simply Safe Dividends gives us a safety score of 88, solid. Union Pacific has been a great dividend growth stock for investors with 15 years of consecutive dividend raises, averaging 14% per year over the last 5 years. Last year, we've seen an 11% increase as the company has announced 2 raises in the last year. I believe part of this was due to the dividend payout being somewhat stagnant during the uncertainty of those first few months of the COVID pandemic. Revenue is up over the last 10 years, albeit it's cyclical, but it's consistent and reliable. Buybacks are done annually at Union Pacific. In 2012, there were 952 million shares outstanding, and today in 2022, we have 631 million shares outstanding. Every time shares are brought back, the shares we hold become more valuable as they own a larger share of the business. 30 Wall Street analysts have covered Union Pacific in the last 90 days, 11 rated as a strong buy, 4 a buy, 14 a hold, and 1 a sell. The average analyst price target is $213.75, which represents about 9% upside from current prices. Union Pacific has been thriving over the last 150 years, and I don't see this slowing down any day soon. Now, there have been some labor concerns, murmurs of a strike, and this is a real concern, and I think these sort of things could provide a nice long-term opportunity for investors like you and I who want to hold quality companies like this. And I buy this one regularly in a few of my accounts. Company number 3, NextEra Energy. NextEra Energy is an American energy company and the largest electric utility holding company by market cap. Their subsidiary, Florida Power and Light Company, provides power to over half of Florida's residents, and they also are the world's largest generator of renewable energy from wind and solar with their subsidiary, NextEra Energy Resources. We highlighted this company in another video a few weeks back because I think this entire sector has recently shown some value, and NextEra strikes me as one of the best ideas in the sector. NextEra is down 14% year to date and trading at $78.80. NextEra is trading at a 26.8 PE, and this is slightly below its 5-year average of 27.6. It trades more expensive than many of its peers with the utility sector average of 17.9. You are paying for quality here. I am a buyer of the stock. The dividend yield is 2.16%, and this is right in line with its 5-year average. NextEra Energy is paying out 58% of its forward earnings in dividends, and the preference is to see this below 75% for a utility company. And Simply Safe Dividends gives us a safety score of 99, the highest possible score. This is a dividend that is not going away anytime in the foreseeable future. Also, their dividend growth track record is much stronger than what you would normally expect from a utility. Granted, you are sacrificing some current yield here for dividend growth, but that's 26 years of dividend growth, making them a dividend aristocrat with a 12% annual growth rate over the last 5 years. Revenue growth has been slow and steady, and this looks really great for a utility. $14.3 billion in revenue 10 years ago, and in the last 12 months, making almost $20 billion in revenue. No share buybacks here, but that's standard for utility to issue shares, and it's not been at a crazy rate. Now, 19 Wall Street analysts have covered NextEra Energy stock in the last 90 days, 7 rated as a strong buy, 8 rated as a buy, and 4 rated as a hold. So Wall Street overall appears pretty bullish on this one. The average analyst price target is $92.90, and this represents about 18% upside from current levels. So I think there's a lot of upside to go. If you don't like paying the premium here, another good option is the ETF XLU, which gives you broad exposure to the entire sector for a very reasonable expense ratio. You can also check out the video a couple weeks back we did that highlights a few more companies in the utility sector that I see as appealing right now, and I'll leave a link for that in the description. Company number 4, National Retail Properties Inc., ticker NNN. National Retail Properties Inc. is a real estate investment trust that invests in high-quality properties subject to long-term triple net leases. The company was originally formed as Golden Corral Realty Corporation, created by the owners of the restaurant chain Golden Corral to allow their employees to have a way to invest in the company. Today, they hold a diversified portfolio of 3,305 properties with over 380 tenants across 48 states with a 99.1% occupancy rate. Some of their top tenants include 7-Eleven, Master Car Wash, LA Fitness, Taco Bell and Arby's, Dave & Buster's, AMC Theaters, Sunoco, Chuck E. Cheese, Best Buy, among many others. An excellent choice for real estate investment without the hassles of being a landlord. NNN is trading just below $43 at the time of publishing and is down over 10% year to date. The price to adjusted funds from operations is 13.3, which is a good bit below its 5-year average of 15.5, and also right in line with the sector average of 13.7. Remember, when we're looking at these real estate investment trusts, PE is a useless metric. We look at price to adjusted funds from operations. Investors can get national retail properties for an excellent yield of 5.12%, and this is about 11% higher than its 5-year average of 4.6%. This is one potential indication of an undervalued stock. NNN makes the dividend payment every quarter in the amount of 55 cents in the months of February, May, August, and November, for a total annual payment of $2.20. And remember, as a REIT, these payments are non-qualified, meaning they are taxed as ordinary income. The payout ratios are looking healthy for a REIT: 68% of adjusted funds from operations and 65% of free cash flow. National Retail Properties sports a solid track record of dividend growth, paying dividends for 34 years and growing them for the last 32 years at a rate of 3% annually over the last 5 years. Slow but steady growth, which is acceptable for a stock yielding over 5% like this. You can also check off the box for healthy revenue growth. In 2012, sales were at $352 million, and in the last 12 months, that number is more than doubled at $762 million. Out of 16 analysts who've covered NNN over the last 90 days, 4 see it as a strong buy, 2 see it as a buy, 9 as a hold, and 1 as a sell. The average analyst price target is $46.23, which represents 7.6% upside, and consider with that 5% dividend yield, you'd be looking at a total possible gain of about 12% over the next year. I think NNN is one of the best companies in the space for real estate exposure, with a portfolio that is well diversified, not overly concentrated in any one particular business or company or industry. Very solid dividend fundamentals for income investors, and one of the best dividend growth track records in the real estate sector. Lots to like, and I think this is an interesting time to be looking at their shares. As promised, here are 3 additional companies I believe are very intriguing at this level, and I consider these to all be high quality companies worthy of a spot on your watch list. The first is Vici Properties, ticker VICI. This is another real estate investment trust. For myself, I added this one when it dips below $30. And there have been opportunities for that in the last few weeks. Owning this company gives you some exposure to some of the finest resorts and destinations in the world, such as the many iconic hotels on the Las Vegas Strip. Right now, it's yielding right around 5%. The next bonus option here is T. Rowe Price, ticker TROW. We featured this one in last month's video for dividend stocks in October, and this one is still looking like an extremely compelling long-term play. Down nearly 50% in the year of 2022, its yield is at 4.7% while we wait for things to turn around. And this is a company that has virtually no debt and an amazing dividend growth track record. And finally, another stock I believe needs to be considered for dividend growth investors at this time is none other than Microsoft, ticker MSFT. We featured this one in a complete valuation video a couple weeks back, and I'd encourage you to check that out if you are considering adding Microsoft to your portfolio. I like it under $225 myself. And if it goes under $200, I'm going to be adding to my current positions. Simply put, there is one of the best companies in the world, and while a dividend of 1.25% is nothing to get excited about, they grow this dividend at a rate of 10%, and over the last 10 years, Microsoft shareholders are up over 650%. This is the company that will be holding a lot of my money for the next few decades, and I think its valuation has finally come back to a somewhat appealing level and deserves a spot on your watch list. Thanks for sticking around, folks. I hope you've enjoyed this, and give me a like and subscribe if you did. You can also check me out on Twitter at DivGrowthIncome. I love connecting with you folks and talking all about investing. And until next time, guys, keep investing.